Hey friends, Lucian here with the Bullish Bears team. This video is going to be on how to trade weekly options. So this is going to be an overview on a couple of the most popular trading strategies where you're going to be buying at the money weekly contracts a week or two out, or less than a week. So either 1 to 2 week out expirations, and then also with selling credit spreads. So you'll see over here expiration dates here on the options chain, and you'll see gray areas, and then you'll see the weeklies right here. Gray are monthly expirations, and then you can see these other ones right here, which are weekly expirations. Now, typically, again, there's all different terms. There's weeklies that are going out, obviously, a couple months. But typically, a couple of the most popular strategies there are for short-term trading. For day trading are those short-term swing trades. So when you look at those like weekly options contracts, you'll see the shorter the term, right? The numbers here, this is the amount of days left. You'll see if I pull up Apple and we go to an at the money strike price, which is the strike price that is closest to price, that would be right down over here, that $120. So if I was to buy the ask on this, it would be $460 because each options contract is worth 100 shares. So it'd be 460 times 100, or $460. So that's for a $36 out expiration. So that's more of kind of like your swing trading style. If you're going more into that day trading arena or short-term swing trading, then you could go at, here's a couple right here. There's a week or day out, and then there's a week out. So that's not a weekly though. But so let's go to, there's a 15, we can do a 15-day out, and then we'll look at the 1 day to show you the difference. So you'll see the price for the 120 is $273. So it's almost $200 less. The reason why is there's less time until expiration. So when there's less time until expiration, it's going to be cheaper for the options contract. So when you're trading these at the money options, if you're an options buyer, kind of a day trader or short-term swing trader, you're looking to capitalize on those short-term volatility moves. So you're buying like either at, one strike, at the money you're buying, or a strike, let's say, in the money, and you're just capitalizing on those short-term moves. So you'll see, obviously, the price of the options contract is cheaper because there's less time left. Now, if you go out to 1 day until expiration, you'll see it'll be even cheaper, where if I look at that same $120 contract, it's 59 cents. So 59 cents because there's a day left until expiration, whereas, if you go out, to the monthlies, it's, $460. So again, there's strategies to employ for each of these. This is, again, short-term moves. If you're looking to day trade, like a really, a day trade, short-term day trade, or like even holding overnight at times, a day or two out can be a good strategy. Again, a lot cheaper to get into the options contract, very volatile, obviously. But again, you're not having to put up lots of capital, and you're not looking to hold long-term. So that's a popular strategy, those short-term weekly contracts, either the nearest Friday expiration, it could be a day or a few days out, or, the following week. So you're looking to go, either real short-term, like, the same week, or typically a week out to expiration. And if you're day trading options and being an options buyer, you're buying at the money or like one strike in the money, and you're just trading those quick short-term moves. So this is a way, again, to trade options, trade them short-term, and not put out a lot of capital. Another way that you can do it is do credit spreads, right? So you can do, instead of being an options buyer, you would be an options seller. So again, let's look at this probability of in the money right here. So you'll see this is your probability of success as an options buyer. The higher in the money, or the deeper in the money you go, the more the options contract, because you have a higher chance of success, of being in the money. So you have a 90, like right here, 90% chance of being successful. That's why when you're going down here and you're trading at the money, you're trading those short-term volatility spikes, and you'll see the odds of success on that trade are 44%. But you're not looking to hold it to expiration, right? You're looking to get in and out, right? So same thing if you kind of open up here, a day left, kind of looking down right over here, odds are not very high, but if you were to trade this one with a day left, you're probably not going to hold, till tomorrow. You're looking to probably trade it within minutes today, right? So again, price is cheaper, but this is this probability of in the money shows you your probabilities as an options buyer. Now, this same thing can be said and flipped on the other side with an options buyer, right? Or an options seller. If you're an options seller, you're selling credit spreads, you're looking to sell to somebody else. So you're looking to go more out of the money, and you're looking to sell to somebody that's kind of the sucker, right? They're the new traders or people that are hedging, right? There's a lot of new traders that are buying the cheaper ones because they don't know what they're doing. And then there's a lot of other people that are buying them for a hedging. They're hedging current positions. So you could be the seller and sell that options contract to them, and collect a premium. So a way to do that is just basically, kind of looking, let me collapse these again. Go back to the scenario of Apple. And now you're looking, let's say you're building a credit spread. You're going out, for the sake of this right here, before I get into credit spreads, you're just an option seller. So let's say you're selling naked. Very, very careful. You need to be careful. I don't recommend selling naked options, but if you were to do that, you would just look right here. You can see if you sold, let's say this strike right here to somebody, it says probability of in the money, actually right over here. Probability of in the money is basically it's 17%. So that means you have over an 80% chance of succeeding on that trade if you're an options seller. So you could just sell this options contract to somebody else and collect the premium. The problem is if you're just selling it naked without doing a credit spread, if it turns against you, it could rip your head off selling naked options contracts. They're much more risky than buying naked. When you buy naked contracts, like up here, the most you'll lose is the 465. If you come down here, if you sell and you're just going to sell a naked contract, when you go to confirm the order, your max profit is $130. Your max loss is infinite. So even though you have an 80%, success rate on the trade, you do one, maybe two trades, you could completely blow up your account and get in serious trouble if you're selling it naked. So that's where you would come in and you would do something like a credit spread. Again, this video is not going to be all about credit spreads, but you can change, we have in our courses, we teach you how to do credit spreads, but this is a way where you could, instead of, again, being an options buyer, day trading them and, trading at the money, calls and puts, you could be an options seller, look for high odds of success and sell credit spreads that expire, a week, 2 weeks out. So you can see this right here, this is 36 days out. Obviously, if I go back to those other, so that's $130 for, the $130 strike. If we go to those other ones up here and find the same ones, $130 strike, 33 cents, right? So it's way less. It's instead of being $133, it's $30. So this is you're collecting this premium when you do it into, a credit spread or if you're selling it naked. But again, the risks associated with, this can be very high if it goes against you. But you'll see the pricing is different. So if you're selling weekly credit spreads, this is a strategy where you're kind of looking at probability of in the money. You're selling to either the sucker newbie traders way out here or those that are trying to hedge, and then you're collecting the premium. So that's a couple of the popular strategies between buying and selling. If you're an options buyer, you're trying to capitalize on those short-term volatility spikes. You're kind of in and out, either day trading them or short-term swing trades. You're buying at the money, so the closest strike price to the current price of the stock, or a strike in the money, and you're just trading those quick moves, or you're selling those credit spreads and collecting premium. And again, because that's for people that are buying those out of the money options contracts that are either one, they don't know what they're doing, or number two, they're looking to hedge on their current positions. So again, if you need more help, we teach all the different strategies in our courses. We have a couple options courses, so we teach how to do credit spreads. Also, instead of doing naked options like this, there's ways you can do debit spreads and other strategies as well. So hopefully this video helped you. Again, make sure to take our course resources if you need more assistance with all the different option strategies, and we will see you in our community. Enjoy.